So you need to be in the wholesaling bucket in order to pay for order flow and in order to get that order flow. Otherwise, you compete for it naturally if you're not. And there are a few of the market making firms who are not wholesalers, so they are not paying for order flow. Okay. And I can't say any names, but there's a handful of them. So the ones who are wholesalers who pay for it, they are in the business of making a written contract with an order flow provider like a brokerage house or Apex, which is a big clearing entity. They route orders. Whoever routes orders to the marketplace, they make an agreement with them that, hey, send me your order flow, and then I'm going to give you X amount of pennies.
Hello, Wealth Builders. You're listening to Wealth Building with Options. Here's your host, Dan Passarelli.
Hey, Wealth Building family. Welcome to episode 30. And today, holy cow, we've got a really great episode for you. We've got somebody very, very special who has a lot of great things to share about the options business and kind of how it all works on the inside. You're going to love it. For the past 37 years, our guest has been involved in stock and options trading. He began his career as a market maker on the Chicago Board Options Exchange, that's CBOE, in 1987. And after 5 years as an independent market maker, he and 3 partners created a proprietary options trading company. He became the CEO and managing partner of the company and oversaw its growth into one of the largest designated primary market making firms in the United States. In 2017, he and his partner created a retail trading platform called TradeHawk and connected their platform to Tradier Brokerage. Today, he's the Senior Vice President of Business Development and Partner Relations, as well as the Chief Content Officer for the Tradier Hub. Please help me in welcoming Kevin Lex Luthringshausen.
Wow, that's quite an introduction. Holy cow. Did I write that?
I just made it up.
Unbelievable. Well, thanks, Dan. Thanks for having me. I'm excited to do this. So this is going to be fun. But yeah, that's all true. Everything you said. And what's interesting real quick is that whenever I say that I'm a market maker to any retail person, right, they kind of react like you're a dinosaur in a museum, a little bit, right? Just a little bit. So they're not used to that term very much because, as you know, the market making community has dwindled down to 12-ish in the space, and they're not people like me anymore, like you were. They are firms, and they are gigantic institutions, and there are fewer market making firms than there are exchanges, option exchanges in the country today. If that's hard to believe, but it's true.
Yeah, that's a pretty crazy thing, man. Wow.
It's nuts. So, yeah.
So you spent most of your career in that space, and we could call it the liquidity providing space, the market making space. And more than a lot of people I know, you've got some really great expertise to share there.
Yeah, so I went into that business, that part of the business, right out of college. I had studied to be a doctor. That didn't sit well with me about my junior year of college, and I decided to switch. Then I was going to be a lawyer. That didn't sit too well with me by the last year and a half of college. And my dad came down for his final parents' visit with my mom and said, hey, why don't you try this trading thing? Because he was very much involved in the option space back then, too. And I said, okay, I don't know anything about it. You know, what do you mean? So we kind of chatted a little bit. And the theme was that I'm a young kid out of college. I have no money, no job, obviously. And his thought was that, hey, I can support you for a little bit while you learn your craft here, and we'll get you kind of introduced to the right people and blah, blah, blah. So I said, okay, sounds good. You know, what every young kid's always interested in at that time. And I was old enough to drink as have his next beer and what kind of party I was going to on the weekend. So I said, sure. And I got introduced to who would ultimately become my mentor and backer, which is a common thing at the SIBO back in those days. And he taught me his style of trading and threw some money in my account, kicked me over the boat into the trading pits. And I proceeded to lose all the money he gave me in 6 months.
Oh man. Well,
Yeah.
then what'd you do?
Well, I was lucky because he still believed in me. So he put up another sum of money for me and said, "Hey, knock yourself out, kid. Get down there and work harder." And it wasn't about working harder, and you know this because you were a market maker too. It's a different game. Okay. It's very, very different from what a retail trader does. And I didn't even know what a retail trader did back then. I just thought you go down there and I tried to do what he did, and he made so much money doing it. I was like, this is easy. Look what he's doing. I was his clerk and I was putting his scalps in and doing this, and it just didn't work. So what I did, the way I bounced back is I started studying and talking to the people in my pit, my competitors in my pit. For the audience, just so everyone knows, these were real trading pits with real human beings in them, not computers on a screen in some New York office or some Chicago office. It was us down there, no computers, with pieces of paper writing things down and trading with each other on paper. There's camaraderie and friendships. They didn't like me at first because I would be a competitor, but we got to know each other, and lo and behold, I became friendly with the folks there. And they were successful. I started quizzing them and asking them what they're doing. And I figured some things out, and I had a different style of understanding premium and theta than after talking to them than I did at first. So I switched from kind of buying premium, which my mentor did, and he was very good at, to selling premium, which became my sort of preferred personality strategy choice that made me buy myself out of my contract in just a few years. So it was that good. Anyhow, that's kind of the nutshell story of it. Yeah.
So let's get a little bit under the hood here in exactly what a market maker does. Like, what mechanically were you doing down there?
Yeah. Okay, that's good. Again, for the viewers, I speak a lot about this when I travel around the country. I do a lot of that for our partners. And one of the things that they ask me to speak a lot about is I'll call it dealer behavior. Okay. And the market maker, like you and I know that term, it still exists, but a lot of the retail folks, for whatever reason, call them dealers. I'm okay with it. It is what it is. I use the terms synonymously. So dealer, market maker. So anyway, dealer behavior. What that group of folks did, and I'll talk about it in terms of what you and I know relative to being floor traders. We were in the game of complete risk mitigation. And all that means is that we had the ability by nature of what we did, which was to post a two-sided market. We had to post a bid and we had to post an offer continuously in every option that we were assigned to. Okay. And in every class that we were assigned to. Okay. And a class is the stock itself, and the series is each option in that class. So if I were assigned to Google, which we had, I had to make a market in every option, calls and puts every month, right? Bids and offers with a size appended to it. Okay, now think about that. So if some retail person or entity or whatever comes in and says, "Hey, I want to buy the DEES, whatever, 200 calls," I've got to give a market. If they say, "I will buy them there," I have to sell them. Right? And I sell my size. I only have to sell what I say my size is. Then I'm left with a residual Greek position. I've got deltas, I've got gamma, I've got theta, I've got vega, and I got rho. Now, multiply that out times thousands and thousands and thousands of trades each and every day. You start building up inventory as a market maker, right? And that inventory has to be hedged. So the behavior of a market maker is typically, and again, I'll get into nuance of this in modern day world, the behavior of a market maker then is, I need to be delta neutral, number one, because I am trading an option in time, and in time has a place, and the place is where the stock is trading right now. I'm willing to trade this option based on a theoretical price, and I'm getting edge when I sell it. I'm getting edge when I buy it, but it's appended to a stock price right now. So I need to get that stock in my inventory to kind of lock up that edge, as it were. Okay. So market makers were doing this over and over and over again, buying, selling, buying, selling, buying, selling, hedging, hedging, hedging. Someone once said to me in the business, there is no edge without the H. You put the H in front of the edge, it's hedge. You need to hedge. So we did that continuously. Now, if you're paying attention as an audience, what we weren't good at as a market maker, and I'm still not good at it, is understanding direction. I am not good at saying, if someone said, what do you think about the market? I would look at them and say, I have no idea. What do you think about Google? Even though I traded it every single day of my life, my career life. And I said, is it a good buy or not? I go, I don't know, nor do I care. All I want to do is buy the bid and sell the offer thousands and thousands of times a day and get my hedge on. Right? I mean,
Yeah.
I know you understand that because I think you did that. You were on the market on the floor as well, right, Dan?
Yeah, exactly. I was a market maker on the SIBO.
Yeah. Okay. So that's where I was. So yeah, and they're shocked that they go, you don't know the candle patterns? I go, no, I can't even spell candle patterns. Are you kidding me? I don't know what that means. So anyhow, we didn't use that. We didn't use that. So we had a very statistical volatility, implied volatility kind of model and theoretical model that we used, and we wrote our own. So that's what we did. And we just did it over and over again across as many stocks as we possibly could do. Right. So let's fast forward to today with our retail community. You know, when you hit the send button, it's going to a market maker ultimately. It's going somewhere to an exchange, or some internalizer, or some wholesaler, right? When it hits there, they make a market for you. And they want to fill that order, assuming it meets their theoretical standards and, you know, that sort of thing. And they're willing to take the other side because there's edge in it for them. And when they do that, they go about their business of hedging. Okay, now, the caveat nowadays with hedging is that these 12 firms, there's not 10,000 of us or 20,000 of us anymore, there's 12. They probably don't hedge as frequently as they did in the day. And they have this huge dispersion book of things in their portfolio. And they trade Google off of something else in the portfolio because they figured out there's some correlation or not a correlation to it. And they'll trade their book that way. So they might not have to hedge as much each trade because the book is overall hedged, if that makes any sense.
Right. So, well, let me ask you about this, which I bet is something you've heard before. People ask me about this all the time. In fact, ask is probably not even the best word. They get fired up about it. They say, aha, market makers. You're the guys on the other side of my trade. So if I sell a put to you, you're buying it, and of course you're going to win. So how can I beat you? You're the bad guys. What do you make out of that?
Yeah, I've heard that. I think it's a misunderstanding. It's not true. The market making community needs retail order flow. Okay, that's number one. Number two, they need it so much that they're willing to pay for it. Meaning, we all know what PFOF is, payment for order flow. They will only pay for true retail order flow. They will not pay for pro tail. They will not pay for institutional. They will not pay for anything else. They will pay for retail. They have no utter interest in disenfranchising the retail customer, and they will give price improvement to retail customers on occasion. So they'll give you a better fill than you are intended to have because they love you so much. So it is bad for a market making firm to have retail traders angry with them. Now, to your point about someone's got to win a zero sum kind of game, the only thing I'd say there is it's, you know, look at the market maker could certainly lose on his put in that example, but make on his stock, on his hedge. So then that means someone's losing on his hedge. Okay, and it could go on down the line to someplace, and someone's could be ultimately losing in someone in the market maker's hedge. So he doesn't really care after he gets his hedge off. He hopes you make money, and he doesn't care because he's hedged. Doesn't matter, right? So ultimately, I guess it's zero sum somewhere along the way, somewhere along the curve. But the market maker, as long as the hedge happens, he probably wants you to keep winning, so you are in the game and keep trading. That's kind of what he wants, right?
Yeah, I kind of compare that to like an ecosystem. I mean, if only the market makers won, everything else disappears. So the market makers need the retail, and the retail needs the market makers, and the institutional people fit into that whole thing too.
100%, yeah. And the most important part for the market making community is that retail, because the reason they're willing to pay for this, okay, is because to a market maker, a retail order or retail order flow is non-toxic. What does that mean? That means that typically a true retail person does not have inside information or any sort of information that leads to directional bias in the order. They're not doing it for that reason. You know, from a learned source like Congress, for that matter, or someone like Goldman Sachs, who has a giant customer or knows that there's potentially a takeover coming or there's hitting on the pipes, takeover's coming. So for a market maker to deal with the retail, that non-toxic market is huge. The other part that's really huge for the market making people relative to retail is they tend to come in small doses, 1 lots, 2 lots, 5 lots, 7 lots. Think of it as just fine tuning the curve in the options pricing model. So every little trade is a little pump, 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 and a little bend of the pipe, and it gets them an information where the curve can be truly fit based on supply and demand of little small orders. So they get a very good solid pricing mechanism of what supply and demand is along that curve with the order flow, the retail order flow as it is. Because retail order flow, it's huge now. It's 41% of all order flow, right? And that's a big number. And the more that happens in little pieces, the better that curve can be. And the more the market makers can tighten up those markets. It's done a tremendous thing for democratizing retail trading, that payment for order flow mechanism. It's huge because now firms like ours, we can offer free trading because we're getting something on the back end. We're sharing in that. So to our end customer and your customer, guess what? You're trading for zero in a lot of places or very little versus $1 a contract, $1.50 a contract in the old days. What happens when it's like that? Markets widen, right? So you've noticed that over this time, this markets have really tightened up. Spiders are pick a market. They're penny wide, right? So that has had a huge effect in the marketplace, right? In a positive way for the retail person. So it's good news, I think.
Wow. Okay. There's so many great things to talk about here. Oh my God. So I want to get into this payment for order flow thing because it's an interesting topic to me, but I have that trader's memory, which means like extreme, like a squirrel with ADD.
Yeah, right.
On 5 espressos. So I don't want to forget another thing that you mentioned.
Yep.
So you mentioned the word dispersion model trading.
Yep.
And that's something that I recall seeing a lot on the trading floor back when I was down there. And you've got a fair amount of experience with it, I think.
Mm-hmm. Yeah.
Can you tell our listeners exactly what that is and how it works?
So I'll give it, I think it's easier to give it more of a general case for it. I think you'll understand it better than exactly. So a fairly common practice among trading firms early on was to send out their soldiers, their traders in their firm to each and every pit, right? And they would trade individually in each and every pit. And they would manage their own book in that pit. And just for your listeners, the pits were defined by the number of products in that pit. You could stand there and you could physically trade n number of products in each pit. So for instance, we had Google in one of our DPM pits. So a guy trading an IBM did not have Google. If he wanted to trade Google, he had to walk physically over to Google and put himself there and start trading there. Okay. So that was a physical, difficult thing to do. The trading firms put people in all the pits, the bigger trading firms, so that they had exposure in each of those pits. Okay. And again, back to the model of trade, and hedge, hedge, hedge. Well, as time kind of went on and technology advanced and we became more and more of an electronic system, we went to hybrid first, if you remember, and then we went fully electronic. So now all of a sudden machines started taking the place of humans a little bit and markets were being made by computers. That was the final end of it. What these trading firms figured out is that there is a connection among all these products that they were trading, and they could gain access to the connection by having exposure in each one of these pits, and then have a basket of all this stuff in one spot and hedge it as one entity product. And they might do little bits of hedging in between, but what they were doing is simply an implied volatility play, is what it was in true parlance, right? And all that means is that they believed that mathematically the sum of all the parts was not the same as the whole, okay? And the whole would be the SPX in this example. So most people, the S&P 500 has 500 stocks in it. You could trade each one of the 500 stocks and have a volatility position, and then you could go sell it in the SPX and offset all of that. Now, that was the typical method because in reality, the implied volatility of SPX was always slightly lower than the basket volatility of all the components. Why is that? Well, if you think about it, it should be because there is not perfect correlation of each of the components in the basket to the SPX. There are outliers in that. So there's a lot of less than 1.0 correlations, which you hope there are. And if that is true, which it is, then you want to buy all the component volatility, sell the basket volatility, or I'm sorry, the SPX volatility, and you want dispersive movement in each of the components. You want 50% of them to go up really big, 50% to go down really big. What does that do to the SPX, assuming it's equally weighted? It makes the index unchanged, and you've sold premium there, and you collect that, and you make on your dispersion. Does that make sense?
Yeah, this is fascinating stuff. And, I wonder if you have kept up with it, talked to some people in the business, still in the dispersion model trading business. I wonder how that is nowadays, where the Magnificent Seven makes up 35% of the SPX. I wonder if
Yeah.
it's changed.
Yeah, that's a good point. I think it has. That'll be episode 2, maybe if you have me back, because I still have a really close pal who does a lot of risk for one of the market making firms. And that's a question. He wouldn't give me the nitty gritty detail, but he'd give me the generality of how that works. But that's a great point, because that is certainly true. And I know folks who probably could get a pretty good representation of that Mag 7 plus a couple others and get the bulk of what they need done relative to a good hedge. And if you think about what I just said, it makes good sense, right? In terms of a strategy. It really does. And one of the early groups who did that was a company called O'Connor. I don't know if you remember them from the floor.
Oh, yeah.
But they were the ones, if you remember correctly, and we had a lot of DPMs on the SIBO floor, they would come into our pits, and they never were in the pit. They would just come in with their sheets and go, those leaps up there, I can buy those. They would never sell anything unless they're closing in the individual equities. They'd always buy stuff. And to their dispersion model, they had a mispricing in something. It was too cheap on the board relative to SPX and relative to everything else in the term pairs. And they come in and buy it. And they would say, I turn to them and go, how many do you want? He goes, as many as you want to sell us. Just give me a number kind of thing. So I'm like, okay. So you have to give them a number. 1,000. That's fine. Perfect. We'll take 1,000. So they didn't even hedge it. They just went to the big basket, and it was a great opportunity for them because some individual name was mispriced volatility wise against the basket. And this was all done systematically, right? They had a big mathematical model, basket variance, sum of all the products of, I think it's the summing of products of weights, implied volatilities, and correlations across all stock pairs. So that's a big calculation. You need a computer to do that. But once you have it, it's easy, right? And then you can see your basket implied volatility, you can see your SPX volatility. That's already given. You already see that. So, and they probably had curves that it got too far apart, get out of it, too tight, buy more of it.
And, this is kind of interesting relative to what we talked about a minute ago.
Yeah.
I mean, I think this is probably also a situation where this is not really a zero-sum game, because they're hedging kind of air quotes,
Yeah,
that trade against different stock and against the S&P options.
Yep.
Whereas you're just hedging it with the underlying and having the gamma and then selling something or buying something else against it.
100%. Yeah. And when they get out of whack delta wise, for whatever reason, they're going to find out where it's coming from and go put out the fire there. Or let's say it's kind of dispersed and the deltas get away from them a little bit because of whatever. They might trade futures against it, right? They might go over to the futures market and trade S&P futures to get themselves back in hedged line, right? So, I mean, they have a whole world of products to push into the equation. So that's why I think the 12 market making firms, there are some who still do micro hedging. I know that there are. There's, like a Susquehanna or Citadel, probably pretty macro, pretty much at the basket level. They're not making a hedge on every trade they make, is my guess. Yeah.
So if market making and dispersion model trading, if this whole thing is all revolving around basically mathematically volatility being wrong, it's safe to say, well, is it good or bad for retail traders that arguably implied volatility is probably always wrong, at least in somebody's opinion?
Well, yeah, it depends on how you use it, right? So that's a good point. I think in an individual instance, like just if you just trade Apple and you don't have it meshed in with a whole other basket of things, Apple volatility unto itself can be computed, right? Is it high? Is it low? Is it average? that's a good thing to understand as a retail trader. Now, there is a caveat, right? The caveat is this, that implied volatility is always a forward-looking sort of phenomenon. That's what the market making community is telling you implied volatility will look like, or the move will look like based on the implied options, right, of the underlying. The realized vol or historical is what happened in the past. So a lot of people compare them together. And I'm like, well, you're comparing a future-looking thing with a backward-looking thing. It's not exactly right. If you could compare a forward-looking implied volatility with a forward-looking actual volatility, then you have something. That's a lot harder to do. That's predictive. Okay. But it still gives you a good flair. So they call it over VIX, under VIX. Some people do. And I guess the point of it is that when implied volatility is on the higher scale, IV rank is high, right? People say, well, I want to sell it. I'm like, okay, that's okay. But just remember something. You can't blindly sell it forever because you have to buy something against it as the hedge. So you're going to have to buy something up in that zone too. That's number one. Number two is, who says that implied volatility is high enough for what the stock is actually doing right now? You don't know the answer to that, do you? It could be too low technically based on how it's moving, in which case you're selling what you think is high that is actually low. So I always give the example of musical chairs. There are times when you want to buy high volatility, implied volatility, because the stock is just moving around a lot. But like musical chairs, when you get the first inkling that the music's going to stop, you better get your ass into a chair, or you're going to get hammered. Same on the sell side, right? So got to be careful. I remember when Timber Hill thought IV in SPX was cheap at 10. This was years and years ago. They loaded up on 10 because they'd never seen it that low. Guess where it went? It went to 8. They got their you-know-what handed to them because it was technically high relative to the environment, and they didn't know what the environment was going to be. But it was technically high, and they made that bet and lost. And I got to tell you, we lost enough on those kind of bets too, right? On those kind of vega bets. We definitely had our trouble at certain moments. I mean, if you have enough money and you have good movement and you can hit the markets well, you can wiggle out of it. You know, we always had to be able to trade all day long on bids and offers, so we could kind of mitigate that vega position by trading, right? A retail person doesn't have that luxury. So, yeah.
All right. Well, with covered call and cash secured put investing,
Yep.
which is pretty much the focus of our show, really. So arguably there's some edge if you can identify not high implied volatility, but overpriced implied volatility.
Mm-hmm.
But I do recognize that word arguably is pretty relevant. How important would you say implied volatility would be for your typical covered call and cash secured put investor?
Sure. Yeah, so that's a little bit different now, right? Your question is valid there, and the point's valid. All of a sudden, IV becomes way more important there. You want to sell high things there because you're more of an investor now. You have a definite thesis on the underlying stock. The reason you own the stock is because I'm assuming you feel that it's going to go higher, right? Same with the cash secured put. The reason you're selling that is because you feel that you were willing to own that stock if it's put to you. And if it isn't, you're going to roll it and keep doing that. And you're not afraid of the downside in that particular stock. You want to be long it. Okay, that's an investment. That's fine. I'm not arguing. That's terrific. I love it. But why not sell higher premium and get more for it than not, right? So I would definitely pay attention to that. Interestingly, one of the other pieces of this part, and I don't know if you guys do this, is I think they call it a fig leaf, the poor man's covered call. Okay. I didn't know what fig leaf meant until someone said it. I go, what is that? And they told me. I said, oh, okay, I got it. But that's essentially when you instead of owning the stock, you use a leap, a longer term option, a deeper one, a 70 to 90 delta, let's call it, as your stock surrogate. So you replace stock with that leap, and then you go ahead and sell your call in the nearer terms, and you keep rolling them and rolling them. And you got to be careful because when you get to the long call, you got to make sure to roll that out too if you still believe in the stock. But that has a vega component. And people say, but Lex, it's a deep in the money. Why? I go, no, you don't understand. That corresponding put is going to have a value to it. That's going to be the intrinsic value, the extrinsic value of that call. It is going to be affected by vega and volatility. So make sure that you're not paying too much for that, because it might be better to do the stock in that case because you're overpaying for that way long dated call. So just be careful there. I just actually wrote a piece today for a Reddit post on that very thing, the fig leaf. So That's one of the warning things that you got to pay attention to a little bit. If vol's cheap out there, have at it. Why not? It's defined risk. It's a big, gigantic diagonal. Who cares? I like that better, quite frankly, all things being equal relative to volatility, right? So, yeah, I think it's important.
Yeah, that fig leaf or poor man's covered call, there's nuance to it, man. Because, you have the vertical skew as well. So you could end up in a situation, which I don't know, it's debatable whether it's good or not, where you're selling a higher strike call shorter term with a lower implied volatility than the volatility you're buying.
Yeah, most likely you are. That's
Yeah.
probably true. Because don't forget, for the viewers too, is that you're buying that deeper call, right? Which is a farther out of the money put. In skew terms, that farther out of the money put is probably going to have a higher implied volatility than that same delta call that's out of the money, right? So that's part of the whole skew part. So yeah, you're right about that.
Well, let's switch gears and go back to another thing that you mentioned that I would love to hear your thoughts on. So you mentioned payment for order flow.
Mm-hmm.
This is a subject that I never know whether or not to bring up with guests from brokerage firms.
Yeah,
It seems to have this cachet of controversy around it.
right.
Can you explain what payment for order flow is, and is it a good thing or a bad thing, and how relevant it is to people who are
Yeah,
trading?
sure. So first of all, what is it? So it's what it signifies, payment for order flow. So someone's willing to pay someone else for the right to see that order flow. Okay, that's what it is. The people who pay, they call them wholesalers now. Where'd that come from? I'm not sure. But not every market maker is a wholesaler. So you need to be in the wholesaling bucket in order to pay for order flow and in order to get that order flow. Otherwise, you compete for it naturally if you're not. And there are a few of the market making firms who are not wholesalers, so they are not paying for order flow. Okay. And I can't say any names, but there's a handful of them. So the ones who are wholesalers who pay for it, they are in the business of making a written contract with an order flow provider like a brokerage house or Apex, which is a big clearing entity. They route orders. Whoever routes orders to the marketplace, they make an agreement with them that, hey, send me your order flow, and then I'm going to give you X amount of pennies, dimes, dollars, whatever they're going to give you for it. But they're going to get a look at it and be able to trade it first. And if they don't want it, it goes through the mechanism and it gets sent to the marketplace to be traded. Okay. This all happens instantaneously. So it's not like there's guys smoking cigars in a dark room and the order comes in and they look at it for a while and smoke their cigar some more and say, okay, it's instantaneous. Okay. Some of the rules, and I forget the numbers on them, all this stuff, but you have to trade within the NBBO. So you can't get a worse fill as a retail person. It's got to be within the marketplace. The NBBO is the national best bid and offer. You probably are going to get price improvement. Okay. So it could be a penny or two. Spiders probably not because they're only a penny wide anyway. So you're not getting much there. And there's not much payment for order flow there anyhow because it's so tight. So those are the mechanisms there. If it's not traded by the payer, then it goes, like I said, it goes to the marketplace to fill. And that happens fairly instantaneously. Now, to your point about, is it good? I did it. As a DPM, we were in the business of payment for order flow. We paid for order flow. Okay. And again, it was very manual back then. So I had to get on the airplanes and go schmooze the people who had all the orders and the retail orders and that sort of take them out to dinner. It's not like that anymore, really. You have an efficiency quote now as a liquidity provider. So if you're not providing enough good markets, right, then you're going to go to the principal's office and go to the bottom of the wheel and you're not going to see an order, right? So it's incenting you to do price improvement and have great fills for that provider so that you're at the top of the ladder to see that order flow and pay for it while you're at it, right? So you got to be good at it and you're going to pay for it. Those two things. Now, conversely, the wholesalers will not pay for every type of order. So if a brokerage firm sends a lot of pro-tail sort of orders, pro-tail is a more of a professional retail kind of looking thing. And what does that look like to a market making firm? That's large size orders, hundreds, trading frequently like it's an automated system, hitting the market, boom, 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 rapid fire. That looks peculiar. And then trading more than the 390 rule or the 290 rule, whatever. I always get that confused too. 390, I think it is, in a day. So you're trading that frequently, that size, that often. you're going to get flagged. It's not a bad thing, but you're going to get flagged as not a retail person, and we're not going to pay for that. So they'll tell the router that we're not paying for that anymore, that order flow anymore. So all those things go into play. Now, is it good or bad? I think it's great for retail. And now that I sit on the retail side, I can look them in the face and tell them, listen, without that mechanism, the discount brokerage houses that exist, the Robinhoods, us, the Weebles, they would not be able to provide you zero commission trading without it. Impossible. If it goes away, you will see commissions go back up really high, okay? And you will see markets widen, right? You'll see markets widen because there's going to be less of that, what I said, that pinging, and they're going to go like this, and it's going to be really bad for the retail trade. So this boom has happened because of that, in my opinion. It really has. It really, and like I said, the industry did 45 million contracts a day last year on average. They're at 57 this year. They're going to do some $13 billion contract number this year. And that is unheard of. And I think that it is going to grow even more. I think as folks like yourself who are educating the public, the retail public, and we're teaching them how to take good advantage of the marketplace and do smart things with options, I think it's going to grow and grow and grow. It's such a great product for good leverage. It's such a great product for income. There used to be this taboo stigma on options that they were risky. They are about as safe as you can be. They're way safer than stock. You can either buy or sell stock. That's it. With options, you can do all kinds of things, right? You can be a surgeon with options. So I think as people learn more and more about this, and the internet communities there, great educators, man, sky's the limit.
I love to ask folks who are with brokerage firms for a little bit of insight as to what type of option trades do retail traders most commonly make?
Well, I think at our firm, we have a slightly more sophisticated audience. And what I mean by that is they have a bigger wallet size, so their accounts tend to be a little larger. They're a little bit more mature, meaning they're older in the age profile. So our demographic is probably 45 plus, which is a little bit older. They understand options very well. So they've got great basis in understanding that whole thing. And lastly, lots of complex orders. We do tons of complex orders, spreads, 2 or more legs. Iron condors are very popular, selling iron condors. Iron butterflies, very popular. Credit spreads, put and call, super popular. Don't see a lot of naked call and put buying, a little bit, not a ton, not a ton, but everything is more or less spread. A lot of calendars across months, a lot of diagonals across months. So we see a lot of that kind of stuff. Income generation, the thing we would see, I would say the covered calls and cash secured puts are super popular as well. And I think they're great strategies. I really do.
All right. One final question.
Yep.
Do you have a favorite book or movie about trading?
Oh my God. Well, let's start with the movie first. You're going to guess my age when I say it. I mean, my God, you probably already know my age, but I love Trading Places. I thought it was hilarious. That was a great one. I mean, was it realistic? A little bit. It was kind of funny. Loved Wall Street with Michael Douglas. Awesome. There was another one that was good. I can't remember the name of it, but it was about the guy who rode the bike. He was a delivery guy or a messenger. Remember that?
Yeah.
That trading theme. I'm going to look that up. I'll put it in ChatGPT and figure it out. But I forget the name of it. That was really good. That was probably my favorite one in terms of relevance and kind of, at least at the time I was in my career. But I thought that was cool. Favorite book. I'm going to give a plug now to one of my coworkers who wrote a book, and it's on Amazon. It's called The Options Playbook.
Yeah.
Do you know that? It's by Brian Overby. He's a good friend and one of our contributors on the hub. I tell you, it's pretty darn good. It's great for the beginner. It teaches you all the strategies on what calls and puts are and all the Greeks. It's easy to read. It's in big print and big pictures. And I'll tell you, it's not mathematical or kind of crazy like that. You and I grew up on Natenberg and Macmillan. So those are good books. Don't get me wrong. They're still good books. They're just a little heavier, a lot more math in it. So check out the Options Playbook. So all good.
Okay, Lex, thank you so much for sharing your knowledge and especially your time with our listeners.
Absolutely. Thank you. Thanks for having me. This was really fun. I enjoyed it. We'll do it again. You're actually going to come on my show, right? That's what we're going to do next.
Yeah, that's right. I'm looking forward to that one. Part two.
All right, man. Good. Thanks, Dan, for having me. I appreciate it.
And that about wraps it up for this show. But before you go, I don't want you to miss a single episode. So please make sure you're subscribed in your favorite podcast platform, whether it's Spotify, Apple Podcasts, or whatever it may be. And if you would be so kind as to leave a comment, I would surely appreciate it. Because the more comments that are left, the higher the service ranks us, and together we can grow wealth building with options for the benefit of the whole community. Until next time, invest excellently.
Options involve risk and are not suitable for all investors. Before buying or selling an option, read characteristics and risks of standardized options. A link is provided in the show notes. To learn more about your host, Dan Passarelli, please visit markettaker.com.